Good afternoon, everyone. We want to welcome you to today's LIHEAP Technical Assistance webinar on cost allocation. My name is Benita Sinaraja, and I will be your moderator from the contracted LIHEAP Technical Assistance team at Brilliant. As a reminder, we are recording this call, and we are going to be able to post the recording of the webinar on the LIHEAP OCS website at a later date, so stay tuned to see that in a couple of weeks. You are currently all in listen-only mode. After dialing into the webinar, you should have entered the access code and audio pin, which are located on your control panel on the right-hand side of your screen. It's important to enter in that audio pin, as that enables me as your moderator to unmute your line so that you can speak on the call. When it's time for the question and answer section, you may enter in your question in the question box in the control panel or click on the raised hand icon. And please note, we are going to be holding the main questions until the end of the presentation. Okay, so our goals for today's session are to define costs and terminology, discuss how to handle costs, and review an agency's method of spreading costs among its various funding sources. And before I turn it over to our presenters, I do want to briefly introduce all of them. For those of you who joined our warning signs webinar back in August, many of these speakers will be very familiar to you. So first off, we'll hear from John Thompson, who joined the federal LIHEAP team within the Division of Energy Assistance back in 2015. He's primarily responsible for performing fiscal monitoring on site visits, commenting on draft audit disallowance letters, and working with contracts. And he has almost 20 years of experience within progressive accounting, finance, and budgeting within the federal, nonprofit, and corporate sectors. David Berry is the Financial Operations Branch Chief within the Division of Community Assistance. His primary responsibility is the State Assessment Team, which is tasked with performing state assessments and internal control and TA support for the Community Services Block Grants, and he's a certified CPA. Tom Reel, who is definitely no stranger to everyone, is the technical lead for our Brilliant team and has spent most of his career working within the state of Indiana in the administration of community services programs, including he was the former state LIHEAP director in Indiana as well. And then Lauren Christopher is the director of the Division of Energy Assistance at ACF, and she oversees the federal administration of LIHEAP and has been part of the program for 10 years. So as I mentioned, we will hold question and answers towards the end, but if you're throughout the webinar, if you're thinking of a question and want to type it into the question box in the control panel, go ahead. All right, with that, I'm going to turn it over to John to kick us off.
All right, good afternoon, everybody, or good morning if you're calling from the West Coast or listening in. Thank you, Benita, for the introduction. I am very pleased and a little excited to be able to talk about cost allocations within LIHEAP. And so we're going to start first about what is a cost and the different types of costs. All right, so pretty much as you see right there in bold, cost is an amount where you have to pay in order to receive something. And that can be, it can be valued in a couple of ways: your efforts and materials you place into it, your resources or time. But it's important to remember that, you know, the cost, you know, I know we probably have some people on the line who deal with budgets. It's not just merely the budget amount, but it's what's been expended at towards the end. And lastly, what you'll see here frequently throughout the presentation is references to the uniform guidance that was issued out a few years ago, 2 CFR Code of Federal Regulations, Part 200. So right there, it's just important to remember the composition of cost, and there's the definition. Total cost of the federal award is the sum of allowable direct and allowable indirect costs, less any kind of credits. Okay, so here, important to see or take these terms in. I'm sure you're familiar with some already. Some cost-related terms. You look here, you see the cost objective, and that's the purpose for which the cost can be measured. Now, For a cost of, for some other cost-related terms, I want you to pay attention to cost pool. That is the grouping of individual costs to make allocations. So you have specific costs that are inside of a particular group, and then they'll be dispersed to make allocations within your division. And also look down there, you see administrative costs. And those are governmental, those expenditures within the government that the grantee has with the administration of a public assistance program. So I'm not going to go through all the cost-related terms, but just wanted to highlight a couple of them to you that are, well, all these terms are pertinent to the presentation. I just wanted to highlight a few of them. Okay, for LIHEAP administrative costs. You might be aware of these when, not might be, but as we make our way around the nation and we do our programmatic and fiscal monitoring of your programs, we frequently talk about administrative costs. And so one thing we always stress, and grantees repeat back to us, yeah, we cannot spend more than 10% LIHEAP funds. And so, you know, that's one thing that we have really stressed as we give presentations and speak about the administration of LIHEAP funds. Tribes have an exception, 20% of the first $20,000, or better yet, $4,000, and then 10% to be administrated thereafter. One important thing to remember about the administration admin cost is, and this goes back to the importance of monitoring. When you're out in the field or the grantees, yes, we understand you keep a good track of the administrative costs are not to exceed 10%, but it's also to monitor your subrecipients as well, because what they spend also factors into the whole 10%. So you want to make sure that they're using LIHEAP funds, and if they have, if they are out of LIHEAP funds and still need to use administrative funds, that they're using non-federal funds, not commingling federal funds together, or probably or maybe state-issued funds, but definitely non-federal funds to have administrative, to cover the cost of administrative costs. And going here, we have some typical LIHEAP costs. I'm not going to go through all of them, but you can see for yourself the ones that are usually included, going from financial management down to program reporting. Look at administrative costs that are often included. Application of intake, which is something we see pretty much everywhere we go. The LIHEAP shops, you have direct people that work under the program, and they're usually included under admin costs. Costs that are not included could be a vendor intervention or things of that nature. So it's just important to keep an eye out for, look at this kind of this table and know what is included and not included in admin costs. We also want to point out that admin costs can either be direct or indirect costs. And so looking here, you have direct costs. And pretty much direct cost is just associated under a single objective under the program. And so these are some types of indirect costs that we have for LIHEAP, including compensation or just expenses incurred directly from the award. And here are also some more types of LIHEAP direct costs, including our supervision, program coordination, space occupied strictly by LIHEAP staff. So pretty much you get the gist here is things that are directly associated with the program that an individual is working under. In this case, it would be LIHEAP. Indirect costs, as mentioned before, those are costs that cannot be identified specifically to one project. And so those are, they're not assignable to one by benefiting a cost objective. What we mean by that is if you have it going to one cost benefit objective, it cannot, if it's disproportionate in the results that it emits, then it has to be considered indirect. So some types of indirect costs that we have here is the administration. And under that could fall all the specific offices that are within your shop, executive, legal, human, HR, facilities. That can be spread out as indirect on the depreciation of the building, operations, things of that nature, that anything where the cost cannot be directly associated to one particular cost objective. It's also important to remember that indirect costs are usually grouped into common pools, and that's to benefit various programs. So here you have the table here that I mentioned, highlighted earlier, the cost pool, which is grouping together costs and then allocating them to benefit multiple programs. So from a cost pool, you have either your indirect cost rate or your cost allocation plan. As we go out in the field, we usually ask for, well, do you have an indirect cost rate that's been approved? And you say yes, then we ask for a copy of it, or we want to see a copy of your cost allocation plan to see how your indirect costs are distributed amongst your agency. Next, I'm going to turn it over to Dave Barry.
Okay, thank you, John. I hope I'm not too loud, but that's the cross I must bear, I guess. First of all, we're going to talk a little bit about an indirect cost rate, just so we can distinguish between that and a cost allocation plan. An indirect cost rate is a rate between a grantee or a subrecipient and the cognizant federal agency. The grantee or subrecipient will submit a request to their cognizant agency to accept a specific rate. If a grantee or subrecipient has that either the federal agency or the pass-through, which is the states, would be required to accept that rate. We have seen instances where some states give a provisional rate. If your state gives, if you have an agency in your state that gives an agency a rate, you're not required to accept that, at least by us. You may be within your own state government, and that's just, that was just a one-off type of thing. But essentially, it's an agreement between the federal agency and the grantee who's handling those funds. The other component that if they do not have a indirect cost rate, 2 CFR 200.330, I believe, or 331, requires that the pass-through agencies requires them to either negotiate a rate or establish a de minimis rate, and you can, according to those rules, accept a 10% de minimis rate, so nobody has to fool around with all of this. Most agencies, I believe, don't want to do that if they have costs that exceed, if they have an indirect cost that exceed 10%. And our slide here has a definition of what the cognizant agency is. On the single audit submissions, the grantee will have to report what their cognizant agency is. Typically, it's the agency that has the most funding at that agency, typically. And we can go to the next slide. Essentially, this is just a little bit of how the rate's figured and applied. The cost group at HHS, for example, will accept an application from a grantee. They'll take the total amount of cost, indirect costs that are to be accumulated, and then they will establish it on a base. In some cases, it's a modified total direct, which would be direct salaries and benefits for people that are working on the particular programs. In other cases, it would be just all of the costs that are direct cost assigned. That is important because that's how you'll determine how to pay them. And whatever the rate is, they'll get a provisional rate. And at the end of the year, that would be trued up or down, whichever the case may be. And then you would apply that final rate on their total spending. But essentially, to put it in broad terms, if they have a direct cost base, I think we use an example of 300,000, and they have indirect cost pool in total of 45,000, they would have a 15% rate. So they would be permitted to use 15% of their direct costs for each program to be reimbursed. And we can go on to the next one. Now, the reason we're here is to talk about cost allocation plans. If you have any questions on rates, you can please, either at the end of the call or you could find a way to get a hold of your LIHEAP or CSBG representative, and we will do what we can to help you. But a cost allocation plan is very similar, at least in effect. It is for those agencies that do not have an indirect cost rate, and it allows them to allocate their indirect costs based on some methodology. And if we can go to the next slide, we can maybe give a little visual to it. Certain things, the indirect costs, the things that John talked a little bit about, your indirect costs for your executive offices, your facilities, HR, finance, IT, those types of things that you can't assign to any one particular program may get shared amongst different programs. Now, on this slide, we have 4 programs listed. These are just examples. Other thing to note is that if they have non-federal program activity, whether it's other grant programs or even for-profit programs, they have to assign an equal amount of those costs to those non-federal programs as well. You can't use just the indirect cost to be charged to all federal programs and then have your non-program activity. This is bonus material, by the way. You can't have non-federal program activity have no indirect cost assigned to it. So we can go on probably to the next slide. Oh, wow. All right, so the cost allocation plans can vary. These are some common elements that you want to make sure you have in your cost allocation plan. And essentially it has to do with who's doing this, why are they doing it. Let's take a look at their organizational chart to see if their plan or their methodology makes sense. You want to get an understanding of what group does what. If they're telling you they're going to spread the accounting department out only over CSBG and LIHEAP, well, why wouldn't they share that with their other programs? And there may be a reason. They may have a department that provides support just for those 2 particular programs. So it's good to get an understanding and an assertion from the agency of what they're doing and why this is a reasonable method. Essentially, you want to take a look at their methodology. How do they measure those costs, and what basis are they using to allocate those costs? Presumably every program benefits to some extent from all of these costs. I would of course want to see their financial statements. Budgets are good, but I always want to see audited financial statements if I can, and then have them certified to the accuracy of what they're telling you. I think we can go to the next one. I'm trying to be quick here. These are some of the elements that you want to try to understand when they're presenting that. This is how we would do this. If you did it, great. The most important part here, I believe, is the cost distribution, the basis and the method. We have listed here salary and fringe. That's based on maybe time studies. If you have, say, an accounting department that you're assigning all their costs out and you're trying to understand, well, how much time should be dedicated to LIHEAP? If LIHEAP only takes 5% of their time, and they can demonstrate that with their time studies or personnel activity reports, something to support that, that's perfectly reasonable to use that. If they wanted to use space in a location, how much dedicated space is to LIHEAP and the other programs, perfectly reasonable. How much their equipment costs are, if they're an equipment-heavy business, that makes sense as well. Really, what you want to do is try to tie their methodology to how they run their business and does it make sense. There we go. One of the things that we try to do is make sure, or that we try, and we hope that you try to, is make sure the costs are allocated on a reasonable basis. On this slide, we got the 5 of the costs broken out. If your entities wanted to break out separate pools for each one of these costs and assign those costs on the corresponding method, that's perfectly reasonable to do that. Most agencies in CSBG are not that sophisticated and generally take all of their indirect costs and put it in one pool. This really kind of illustrates it almost as 5 different pools making up their indirect costs. But using a square footage, perfectly reasonable. If you're looking at the finance department, maybe the number of transactions that are processed, those programs that take a lot of transactions, should have more of the finance department cost. How much time do the executive offices spend? And if they can break those out. The IT department, headcount, number of computers, time, that kind of thing. HR, number of staff, how many new hires, what's driving those costs is a good basis to allocate them. Okay, when is a cost allocation plan necessary? Okay, assuming that they don't have an indirect cost rate, an approved indirect cost rate, and assuming that they don't want to use the de minimis 10% rate, if they do not want to come up with a negotiated rate with you, we look at a cost allocation plan as the same or at least very similar to a proposed indirect cost rate, because what they're saying is we've got these indirect costs and this is how we want to allocate them, which is really no different than an application for an indirect cost rate, but they're doing it through you, and this should be generally done at the beginning of the grant year or grant period, but it should be done for those costs that can't be specifically identified with one program or another. Who should prepare it? Your subrecipients for LIHEAP, your subrecipients for CSBG, anyone that has federal programs that has administrative or indirect costs that want to charge that to a federal program that you're responsible for, that's who should submit it. Your state or your tribe will also have those. Typically, those are done by your accounting department and either done with an indirect cost rate or a specific plan. There are some states that do cost allocation plans. That's perfectly fine for us. Excuse me. Who approves the plans? In general, a cognizant agency. If it's our approval of a state plan, HHS will approve it for our direct grantees. We expect the states to approve them for the subrecipients of LIHEAP and CSBG and other block grants. And when is it reviewed? Generally, I would expect you to review it each year when they submit it with their plan, and then when they're being monitored to see, is it reasonable? Is it being applied properly? And is there any need for a true up or a true down of those costs? There'll be times throughout the year that an agency may come to you and say, hey, our costs were a lot more than we thought. Can we have an adjustment? It'd be a good time to review it. There'd be times during the year that perhaps their costs are a lot lower than they had estimated. And while you're monitoring, you might say, hey, we need to consider adjusting this. That's in particular importance for awards that are near the end of their period, so we can make sure that those federal funds are spent as soon as possible. There we go. And I'm going to hand it over to Lauren. I went as quick as I could because I love this stuff, and I hope you got some out of it. If you have any questions, save it to the end, and I'll stick around. And if there's anything we need to look up, we'd be happy to help you. Thank you.
Great. Thank you, David. Good afternoon, everyone. So as David mentioned, your state, tribe, territory, you'll perhaps be reviewing your own cost allocation plan, and you'll certainly, if you're a state be reviewing the cost allocation plans for any of your subgrantees or local intake agencies. And so some of the buzzwords that you'll hear about cost allocation plans are the costs allowable, reasonable, and allocable? Those are your three words that you want to sear into your memory: allowable, reasonable, and allocable. And then in terms of how the costs are being allocated, are you following, or is the subrecipient consistently following an equitable process? I'm going to walk through briefly on the next few slides some of the regulations regarding this from the OMB Uniform Administrative Guidance. Now, you'll probably notice that these are taken from, I believe it's Part E of the Uniform Administrative Guidance on cost principles. So many of you probably realize that those are not required for you to follow for the LIHEAP block grant, but you are permitted to follow them. And so from that standpoint, we're sharing them kind of as a persuasive example of some guidance that's out there. Now, other block grant programs such as CSBG do require that the cost principles be followed. So many of your subrecipients will already be following these, and so it's permissible for them to all follow that consistently.
If I may?
Yeah, absolutely.
I'm sorry. I had meant to mention this earlier. If your state decided to not hold to the OMB Uniform Administrative Requirements or the cost principles, and you instead chose your own grant administration manual or whatever it is you call it, you'll need to find the corresponding guidance. Generally, most states that we've seen, it's very similar in terms of, allowable, reasonable, and allocable. And some of those costs are very similar. The big difference is usually in the dollar limits on specific cost principle items. But for the most part, most of the states we've seen, it's very similar, but you will want to refer to those. But this is the only federal guidance that we have. I'm sorry, I meant to mention that earlier.
No, that's great, thanks. So feel free to jump in anytime.
Okay.
So the first part, are the costs allowable? So as you see from 2 Code of Federal Regulations, CFR, Part 200.403, when you're assessing whether they are allowable, you're looking at, are they necessary in order to administer the grant? Do they conform with all of the different rules that are out there in terms of the federal statute, regulations, policies, the Uniform Administrative Guidance, the Cash Management Improvement Act, any sort of federal rules are out there, as well as any of your own state, tribal, or territory-wide rules that would apply. And as you know, for LIHEAP in particular, a lot of the aspects of your program are not defined, or specific procedures are not set out in the federal rules. And so the LIHEAP block grant regulations require you to be following your own statewide, tribal-wide, or territory-wide rules as though you were using your own state, tribal, or territory money. And so that's at the federal LIHEAP regulations at 45 CFR 96.30A. So you always want to be keeping that regulation in mind as you're interpreting it through these other rules. So again, coming back to, are the costs allowable? Do these costs fall within all these different state and federal rules? Are they being treated consistently with the policies and procedures, as well as consistently among grant programs? You heard David mention earlier about treating all programs consistently, not just having a separate rule for the federal programs compared to other programs. And I just lost my screen, so so the other rules were related to GAAP, following the generally accepted accounting principles, and making sure that the costs are not already accounted for as a match for any other grant program, and making sure, of course, one of your tried and true principles, that you always have adequate supporting documentation that are based on the actual expenditures for that program. So that covers allowable. Moving on to the disallowed costs. So as a federal agency, or you in your responsibility of reviewing the cap for the subrecipients, you're going to be determining whether or not these costs should be disallowed. And so what you really want to be making sure of is, again, whether they fail to meet those established standards and definitions. And again, remembering for LIHEAP that most of those definitions are going to come from your own statewide, tribal-wide, territory-wide rules, matching how you'd use your own funds. Making sure that these costs, if they distort the final results of how the costs were distributed, that would not be allowable. Making sure that if there's no direct relationship, that those are disallowed. And when it's based on just a budget, an estimate, as opposed to those actual expenditures, as we mentioned. The other part of this is, again, making sure that the distribution is equitable. And again, this kind of comes back to if the agency, the intake office is running multiple programs, that they are treating those programs in a proportional manner, that they're not just trying to charge it all or mostly to one program, that that's not really in actuality how that program is using resources. So that percentage share should really reflect how the resources are being used by these different programs. And now I'm going to pause so that Tom Reel can give us an example of this in action.
Okay, thanks, Lauren. We thought we'd throw a couple of scenarios in here and maybe even generate some discussion. Benita, do you need to get some instructions on what to do to discuss this?
Yeah, I sure can. So we do want to make these, Tom's going to walk through a couple scenarios with all of you, and we do want to make it as interactive as we can on a webinar, so you can feel free to basically respond after he goes through the scenario via the question pane. You can just write in a response, or feel free to raise your hand. Click on the raise hand icon and I will unmute your line, and then you can kind of just speak freely. I will not call anyone out by name, so there's no wrong answer. No one will know who it is. If you don't want to, if you'd like to announce yourself with name and what state or tribe or territory you're from, please feel free to do so, but I won't call anyone out in this case. So feel free to either click on the raise hand icon if you wanted to respond, or just type it into the control panel, okay? There you go, Tom.
Great, thanks. All right. So the first part of the scenario is this. The Central State Community Action Agency, one of your community action agency subrecipient agencies, contracts with a public relations consultant and basically tell you it's to get the word out on the benefits that are available from its programs, specifically from 4 of its main programs, including LIHEAP. They show the costs that are generated because of the contract, and the costs include compensation, the space used by the consultant, computers and phones used by the consultants, and office supplies, and then the lease cost of an automobile for the consultant to use in the job. And the automobile just happens to be a 2017 Lincoln MKZ. So my question, and maybe you could raise your hand if you have an answer to this, is the first question I would ask is, well, of course, are the contractor costs allowable with regard to LIHEAP in regards to the definitions that we just heard? Any ideas on this? Mm-hmm. In other words, is the function of the consultant, for example, valid in terms of LIHEAP? Is that the PR consultants getting the word out on the benefits available? Is that an allowable and necessary type of expense? And maybe some of our participants, our panel participants, might have a idea on this too.
We do have a couple of people who have raised their hand or And I know everybody's thinking about it. So if you have raised your hand, your line is unmuted, so you can go ahead and speak. And also, if you feel like just writing it in on the control panel, go ahead. But for those of you who did raise your hand, go ahead if you'd like to provide an answer.
I'm gonna say no.
I think we kind of heard you. Go ahead.
No.
No.
I think the costs are allowable.
I'm
And
getting.
why not? Why wouldn't the cost of the PR consultant to get the word out on LIHEAP be allowable?
This right here will look like he's asking an employee, and what do they need a car for, and all of this other stuff.
Okay, yeah, and I think that would be sort of a secondary question. Is the car necessary? What would we need to know to answer these questions?
Goes back to that other slide where you had all of this stuff.
Well, we'd need to know maybe a little more about what the PR consultant is doing. I mean, it occurs to me that getting the word out on benefits may or may not be the classic outreach function of LIHEAP, right?
No, it's not.
And not to put you on the spot too, so we have some other folks who are just also chiming in. One other person actually agreed with you and said no, they didn't think they were allowable. One person said yes, public relations are allowable. And then I think to answer your question, Tom, too, we have another grantee who said we need to know exactly what the consultant is doing.
Right. And I'm not bringing these questions up with the scenarios to answer the question. But it's more just to point out that there are a lot of situations like this where you need additional information to make the decision. Well, let's just say that we decide that the PR consultant, that the function of that, getting the word out, is outreach, and it's allowable from that standpoint. What about the car? Let's say that the consultant, a big part of the consultant's job is to travel to meetings, to meet with people to talk about these 4 programs. Is that something that you think would be justifiable, or what other information would you need?
I would need to know if there a car that's already a part of the program, because some of the programs have cars, the agencies, and why couldn't they use that car? Do they have their own car? Do they have enough car insurance so that they could drive their own? And is there a what do you call it, mileage reimbursement or anything like that available?
Yeah, that's excellent. I mean, those would be the details I think you'd need to find out. And then again, of course, I'm being a little provocative here, but do they need a 2017 Lincoln MKZ, a $50,000 car?
Why can't you get a little Ford Focus or a Fiesta? I don't know. Why does it have to be leased? Why can't you? I don't know. I don't think that's what, no.
Well, I'm sorry.
Oh, sorry. I was going to say, I think it's a good point. Some other feedback we were getting is that mileage might be allowable if we are requiring the consultant to go to those meetings on, the grantee's behalf, or that it could be allowable, but at the standard GSA rate. And so, and also I think somebody's making a good point that allowable and defensible are not the same thing as well. This is great feedback that everybody's typing in too. So thank you very much.
Right. Remember that, the 2 of the terms used there in Lauren's explanation are necessary and reasonable. We'll talk a little more about reasonable next, but I think that might be, that might come to bear on this too. And we'll continue with the scenario after we go to the next part.
Okay, thanks, Tom. So now we are looking at, are the costs reasonable? And as you see, a lot of times in the law, we talk about the reasonable person standard. So according to a reasonable person, do these costs seem like they're ordinary for this type of activity? Do they follow kind of typical sound business practices? free of conflicts of interest, be it those kind of on the face or kind of implied. Are they comparable to market prices? So I'm sure most of you have similar rules that we have, say when we're doing procurement contracting, where we have to do market research to get a sense of the average market price for a service that we need. So that's kind of our due diligence of looking into that. Do these result from prudent consideration? So, you know, have we given this adequate thought? Well, the person who put together the plan, does it look like it's well thought out? Does it look like it's thorough, well-researched, etc.? And does it comply with established practices and policies regarding cost incurrence? So I guess some general things I would just add to that are that, again, you know, with any of these, when we look at allowability, whether it's reasonable, allocable, you, the state, tribe, or territory, can always be more restrictive than the standards that are put forward here under the Uniform Administrative Guidance. This is sort of the general bare minimum threshold, if you will. And you always want to make sure that, you know, when you're looking at cost allocation plans or anything else, that, again, you have sufficient supporting policies and procedures to tie to that really justify decisions made in those plans or rules. And, you know, in terms of whether the costs are reasonable, you can look to, you know, what are done for other federal programs. I mean, obviously we talk a lot about CSBG. David is from our CSBG team because of so much of the overlap among the local intake agencies for LIHEAP and CSBG. But there are other federal awards that these subrecipient agencies might have, Head Start, for example, and so you can look to certain rules that might be applied there and deciding whether or not you want to incorporate that for LIHEAP as well. For example, when you're looking at personnel salaries and trying to assess, okay, for example, the CEO or other staff sometimes can have very high salaries. Well, do you, either in your state, tribe, or territory-wide rules, have a cap that you need to be following? If not, is there a cap you might want to borrow from another federal program that does have more specific rules about this? Oftentimes we see in some other federal programs, they may cap it at the equivalent of a federal senior executive service person, usually at the level 2. So, you know, that might be somewhere around 180,000, don't quite recall offhand, but you can look to kind of see what is typical. So if you're seeing, you know, maybe $400,000 for a CEO, maybe that's not reasonable. Maybe it is, but it's just really taking into account that case-by-case situation, getting the full context. And now I'm going to pause for...
Well, in general, if we get a lot of questions in CSBG about the reasonableness of some of these extremely high salaries at some smaller agencies. And it does beg the question, what is reasonable? And like Lauren mentioned, some direct federal programs limit salaries paid proportionally to an SES level 2 for whatever region they're in. So if it may be 180,000 in DC, but it may be you know, 160 in Kansas City. I don't quote me because I'm just saying that it varies. SES level pay is published nationally every year. So you would, if you use that as a benchmark, you could have an actual, you know, U.S. government, you know, source for your basis if you choose to do that. You could use state rules if that's what you choose to do. You'll get a lot of pushback, that's for sure. But in general, one of the things to consider is this being evenly applied to all of our agencies that handle our federal awards? And would it be right for you to do that for LIHEAP, but not for other things that are in the state wheelhouse, like CSBG or weatherization or TANF? Those types of things you need to ask internally. That's not something that we can answer for you, but you do have that authority to impose some of those things. We would recommend that if you try to do that, that you at least start putting procedures and policies, and make sure that you have support before you go on that venue, because you'll more than likely get some heavy resistance. But if you build up your support first, you'll be in a much better place. Sorry about that.
No, that's great. Thanks, Tim. And now
it's like a commercial break.
And now we're going to turn to our Tom commercial for the next scenario.
Okay. Well, we're in part 2 of our scenario here, and the plot thickens. The former CAP agency community services director, and she oversaw all 4 of the programs involved, actually resigned her position with CSCAA to take the public relations contract with the agency. Because work required specific knowledge of the programs, of these 4 programs, the consulting contract, which incidentally sets a rate at $200 per hour, was awarded as a sole source agreement. CSCAA has emphasized that this sole source agreement award was in compliance with their own procurement policies. So the question is, in terms of what we've just talked about in terms of reasonable costs, are the contract costs as they're laid out here reasonable with regard to LIHEAP? Any thoughts?
We'll give everybody a minute to kind of review that. And as we did before, feel free to write in your response, or certainly click on the raised hand icon.
You might look specifically at the question as to whether, for example, is the contracted rate of $200 per hour reasonable? And you'll recall that one of the criteria for reasonableness is it comparable to area market prices? So what would be information that you would need really to determine whether this is reasonable? Don't have a caller this time?
I have one response so far, and the grantee suggesting that we would need to research the market rate, or that it might be allowable as an indirect cost.
Okay. And really what ties into that is, was the contract agreement made as a sole source, was that, using sound business practices? And the reason I think it ties in is if it had been awarded on a more competitive basis, then you might already have information as to whether, if they had proposed different rates, as to whether that rate was reasonable or not. But what would you think in terms of, and anybody, in terms of whether this is valid, that it's a sole source agreement?
So I'm getting some responses to that, Tom, that sole source is a concern. And another person asked if there would be a conflict of interest.
Yeah, I think that's a very good question. Any ideas on that? Anyone have specific ideas to whether it is or isn't a conflict of interest?
And I think we have our same caller. I've unmuted her line. Go ahead if you would like to respond as well. The question came up, how long was she separated from the agency as the director? So something to think about too.
I think that could be a factor there. And again, obviously I've set this up a little bit to be provocative again, but one followed the other, let's say, within a short period of time. The suspicion would be that, the contract was all set up for this particular person, but that wouldn't be something that maybe you could really know for sure.
And why is it a sole source as opposed to more of a general procurement? And I guess another question came up, was it advertised in a statewide paper? I guess, again, probably making it, why is it not more open?
I think that would be an excellent follow-up question when you're looking into this, because that would be an indicator as to how competitive they were. CSCAA would come back and say, well, we didn't advertise it because we felt like the person taking this position or taking this contract would be required to have very specific knowledge about LIHEAP and the other programs involved. And we thought that there would only be one person available for that. Again, part of this is your judgment, and part of it is your own agency's policies in terms of procurement and what you impose in the contract, for example, on your subrecipient agencies, what your state regulations are in terms of procurement could come into play. Yeah, any other comments on this? Mm-hmm.
Yeah, so some other folks thought, it certainly could be perceived as a conflict, that they also agreed that the open competitive process might be a safer bet, and then you never know what's out there until you do put out that search. And then I think another comment, which I would personally agree with, that $200 an hour does not seem reasonable. So a lot of different things to consider. Yeah.
Right.
Well, that's how you get that link in MKZ, I guess, when it's $200 an hour. So.
Yeah, that's not too shabby. Get the use of the Lincoln and $200 an hour. Huh. Okay. Other comments before we move on?
I think that's it for this one. So thank you, everyone, for your participation. Keep it up. We've got one more in a little bit, too.
Are we ready to go on?
Okay, great. So thank you, Tom, for that second scenario. So now, last but not least, are these allocable costs. So are they actually costs that are incurred by LIHEAP? Perhaps this is I find it hard to believe, but, if for some reason that local agency had no IT needs, then LIHEAP should not be sharing in the IT costs if that was a situation for that particular agency. So making sure that LIHEAP as a program is actually incurring some portion of the cost for those services, be it IT, HR, finance, facilities, et cetera, et cetera. Making sure that those costs that are allocable are distributed in a reasonable proportion. We've talked about this a bit in terms of, especially as we're talking about a smaller agency, they may have to pool together a greater number of different types of costs to keep that work manageable in terms of reconciliation and tracking. But in terms of deciding, okay, what is that percentage share? What is a fair reflection? You might have a fairly wide spread between, how much share LIHEAP is incurring for HR services versus IT support. And so trying to figure out if they're pooling those costs together, what is a fair reflection of those different types of costs. And of course, making sure that it is a cost that is actually necessary for the overall operation of the agency. David, is there anything else you want to add on that?
No, I think you really hit it. Is that you're not going to come to a perfect answer, and there's no book you can open to say, okay, here's the chart. This is what they said. This is what they get. Really, you want to have an understanding of how do these costs support LIHEAP? How did they come up with this allocation of X percent? They may look at facilities costs as LIHEAP would be probably pretty small because they don't take up much in the way of square footage. So maybe they're 5% of facilities costs, but in accounting, they might be 20% of the journal entries or 20% of the activity because they're writing a lot of checks in LIHEAP. So they might have 20% of the accounting costs. well, what should they charge, 20% or 5%? If they have one pool, it's probably going to be some kind of blend. And what you're going to want to understand is, how do they come up with that amount, and is it reasonable? And does it seem reasonable to you? And that's really what we're getting to. There's not going to be a perfect answer. What federal agencies would look at, if we are looking at it, would say, did you review it? Did it seem reasonable? Do you have support for the fact that you looked at it and that you've evaluated whether it's reasonable or not? That's what we're talking about when we're talking about, are these costs allocable? You know that some of these facilities costs might be for a facility that has nothing to do with LIHEAP. If it's a Head Start facility across town, should that be included? Well, if they only have one cost pool, perhaps it's going to be, but that should be reflected at the end when your rate would be a little bit lower for LIHEAP, because Head Start, if they have multiple Head Start locations, their facility costs would be much higher. So those are the types of things you're going to want to look at. And of course, all of these indirect costs are allocable to multiple programs, to multiple activities. It doesn't just have to be federal programs. If they have non-federal program activity, they get to share in some of the costs as well.
Okay, great.
Yeah, I'm sorry.
No, that's good. Good.
I get a little preachy when it comes to costs.
No, nice summary. So, Benita and Tom, I think that wraps up kind of our overview of allowable, reasonable, and allocable, and we're going to turn it back to Tom for our third scenario on allocable.
Okay, thanks, Lauren and David. So the final part of the scenario here is basically, because of the PR consultant in her activities always provides information with regard to all 4 programs, CSCAA is basing the allocation of the costs, all those costs for that consultant, on an equal percentage of funds for each program. So LIHEAP grant, one of the 4 programs, is being charged 25% of the total pooled costs. So our first question, or our overall question, is, are these costs allocable? In other words, are they based on a valid methodology? Any thoughts on that?
And I do have some general questions that are coming in, and just as a reminder, I'm taking note, and we will definitely address that at the end. And we are approaching the end of the presentation overall, so not to worry, we will address your general questions as well. I do have one hand raised, so I have unmuted their line. Go ahead if you'd like to speak and answer the scenario question.
Okay, no, it's not, because it says that it's for all the programs, but you don't know. LIHEAP may be a $500 and some thousand program, where CSBG only is a $60,000 program. So why would you break that up by 25, 25, 25? Just because it seems logical on the surface, it's not. You would have to look to see what the proportion of what percentage of each program of the 4 each program was.
Right. I think that's an excellent point. And of course, the general point here is that, the allocability depends a lot on a valid method for distributing those costs. And as we said 2 or 3 slides in this presentation, the method has to result in an equitable distribution of costs. And the equitability is in relation of the cost to the benefit that each of the 4 programs receives. So I agree with you. I don't think that this simple allocation methodology is really valid. It seems like there'd be things like time studies and other ways that, or the proportion of the.
Right. This would be the simplest way to go, because there's 4 programs.
Right, it would be, but again, simple is not necessarily valid in that.
No,
so I think there's room taken there. So, okay, well, anyway, I think we can close the scenario here, I think what happened in the end is the Community Services Community Action Agency was sent back to the drawing board by the funding agency and said, you know, you've got to come up with some different planning here. Anyway, we hope that's what happened. Okay. Let me just conclude now with just a couple of slides. In terms of reviewing and monitoring specific costs in a cost allocation plan, again, just quickly review, you want to ask specific questions, and these will be questions that are on your form, your review form, your monitoring form, whatever you're doing. Is the cost allowable, reasonable, and allocable? That's what we've just discussed. Is it within the program limits? Are there any guidelines or exclusions or definitions in the program that preclude these costs? Is it clearly related to the cost objective, or in other words, the funding of LIHEAP in this case, allocated on a valid basis, as we just said? And of course, as always, are the costs supported by written documentation? Can you have, are the costs accounted for using generally accepted principles and methods that you would use? In terms of reviewing the next slide, the cost allocation plan, just to review, you want to make sure it's written, complete, approved, and up to date. And you can determine how often you need to look at the cost allocation plan, but it might be something you want to look at annually, especially looking at any changes in the cap. Is it based on reasonable definitions? Are they consistent and valid in terms of the methodology used? And of course, has the cap itself been properly approved by someone in authority and certified as the plan for that agency? So in overall conclusion, then, I just want to sum up by just saying on the next slide that agencies, you know, have many costs, and a lot of the costs can be directly assigned to LIHEAP funding. They're clearly activities under LIHEAP that are being performed under LIHEAP and directly assigned. But then there are, as you know, a lot of general agency costs that benefit multiple programs and need to be spread some way among all those programs. So this distribution of costs needs to be done in some reasonable way, on a reasonable basis in relation to the benefit that is accruing to each of those agency programs. So just in summary, a properly formulated indirect cost rate or a well-defined cost allocation plan. These are the methods used by the agencies to equitably spread those costs. And as a grantee, you know, you need to review these things and make sure that that these costs are valid and that they are actually spread in a valid way. Benita?
Yeah, thanks, Tom. And just as a wrap up, we did include some resources in this presentation, and as a follow-up, I will be sending out this presentation deck to all of you, so you will have a copy of the slides, because we do have a lot of really helpful references to the federal regulations and whatnot. So here we have some resources on cost allocation plans from HHS or the Department of Ed, and then here is a list of a lot of the regulations that we referred to, and good parts that you want to definitely review as you are thinking about cost allocation for your program. I also wanted to mention something we didn't write on here, is that, of course, when you have questions, do not hesitate to reach out to your OCS regional office liaison as well. They are here to support you. So they are always a resource to follow up with. So with that, we are going to open up the floor for questions. And I actually do already have a list of questions ready to go for our presenters. And so if you'd like, if you'd like to add another question, please go ahead and write it in the control panel, or you can go ahead and just click on the raised hand icon and I will unmute your line as well. So our first question, and maybe some of these that came on from early on, but does LIHEAP have to abide by the 45 CFR Part 75 instead of 2 CFR Part 200, which might be a bit of a specific question without looking at them.
That's okay. I can take that, Benita. This is Lauren. So you might recall I believe it was an information memorandum that we released maybe a couple years ago when the Office of Management and Budget, OMB, basically pulled together different OMB circulars that were out there, and they pulled them all together into this combined guidance called the Uniform Administrative Guidance. So in our IM, when that was first coming about and we were just trying to get up to speed with it, the original citation for it was the 45 CFR Part 75. But what we cite to now, what's been codified in the federal regulations by OMB is 2 CFR 200 point and the various subsections. So from this point forward, you'll hear us referring to 2 CFR 200 rather than the 45 CFR Part 75. So hope that clarifies.
I think what they asked is if those are applicable for LIHEAP.
So the Uniform Administrative Guidance is required for LIHEAP in part. And so when you go to, let's see, it's 2 CFR 200.
330, 2329, 330, and 331.
No, 200.101 gives you a table of which parts of the Uniform Administrative Guidance are applicable. And when you scroll below that table, 200.101 D, as in Delta, talks about what specifically is applicable or required for LIHEAP. And so that's where it talks about that a lot of the cost principles, or Part E of the Uniform Administrative Guidance, much of that is not required. Again, as a state, tribe, or territory, you can choose to require it and follow it, but for LIHEAP specifically, it's not mandatory. For CSBG, the cost principles are. And so again, you'd want to look at 2 CFR 200.101 D as in Delta to see specifically which aspects of the Uniform Administrative Guidance are required for LIHEAP, but definitely the sections that relate to, I believe it's Section F, Part F, about audit requirements, all of that was taken from the old circular, now I'm blanking on the name, the number, but
A122?
Thank you. No.
Or A110?
Yes.
A102?
No, neither of those. Anyway, A133 is what I'm thinking of on the single audit requirements. Those are now Part F of this Uniform Administrative Guidance and are still required and applicable to LIHEAP. And then in addition to that, there are certain sections. Part of what David was referencing earlier is from Part C on the pre-federal award requirements of the Uniform Administrative, Part D as in Delta. It's 200.330 through 200.332. That talks about subrecipient monitoring and management. Those 3 particular sections out of Part D as in Delta do apply to LIHEAP, are required. So I'm not sure if I've confused the situation or not, but if you have follow-up questions on that, just let us know.
Okay, great. Thank you. Our next question comes from Randy Johns. Go ahead, Randy, if you'd like to ask your question. Your line is unmuted. Of course, I may have put you on the spot.
All right. I thought I heard someone say that if one of our subgrantees received the indirect cost rate approved by another federal agency, that we had to accept it.
Yes.
But then the LIHEAP block grant.
That's required in the it's 2 CFR 200. I want to say 331, but of those that Lauren just mentioned, it's required that you accept it.
But if the LIHEAP block grant only allows 10% and they were awarded something that was like 12%, how can we accept it?
If you have to accept it. You probably need to look at what the base is. Hopefully, if it's an HHS grant, most of the base is on salaries. And most of the cost in LIHEAP is going to be on payments to utilities. So it's not going to be, if they have a 20%, it's 20% of their base direct salaries that's charged to LIHEAP. It wouldn't be 20% of the total LIHEAP expenditures. If you have 20% of the total LIHEAP expenditures, reach out to your representative, and we will figure out exactly which one prevails. But I suspect the statute does, and that would mean that even though they're allowed to charge it, it would be not permitted in terms of going over the limit. But the limit's based on the state, the total amount in the state.
So yeah, so he's talking about Assurance 10 of the LIHEAP federal statute that limits for states 10% of your total LIHEAP funding for that federal fiscal year towards administrative and planning costs. And so just trying to understand how to reconcile if a sub-recipient intake agency has a negotiated indirect cost rate, that fits within that overall.
But that if they have it from HHS, there's a very high likelihood that it's based on salaries. Now, if they have it from the Department of Labor, it may be based on total expenditures. We've seen that before. So some of the different federal agencies the cost groups of the different federal agencies base it on different things in terms of the base. But if it's from HHS and it's based on the salaries, your whatever is, if it's 20%, it's still going to, that's based on the salaries and not the total expenditures for LIHEAP. So, but if it is based on total expenditures for LIHEAP, I would reach out to your DEA representative and let's talk about the effect of that.
Yeah, absolutely. We can help on a case-by-case basis. If you share with us the indirect cost rate agreement, then we can have a conversation about that.
Okay, thank you.
Thanks, Randy. Our next couple of questions come from Tammy Childress. I apologize if I said that name wrong, but Tammy, your line is unmuted. Go ahead.
Okay, a couple of questions that I'd had is we talked a lot about cost allocation for indirect. We also see cost allocation plans that include the direct, what they're charging directly to the program. A lot of times they're cost allocating their, for example, their rent or their space, utilities, IT costs. We see a lot of that allocated directly to the program. That seem appropriate, I guess?
Well, that's really a cost allocation plan where they've broken it out as opposed to pooling it. They're giving you significant line items and saying, okay, 10% of our rent goes to this program and 5% to that program. Essentially, they're doing the same thing, but they're doing it on a case-by-case or account-by-account basis. If you wanted to do that, it's not prohibited. How's that? It seems like it's a lot more work for you, but it's that would be up between you and the agency. If you want to get them maybe a little more sophisticated in their accounting and start to pool some of these costs and do it that way, that would be fine too. Really, that's there's no prohibition on that, I guess is probably the best way to put it.
So it's appropriate to include those, to allocate those out as direct cost and then charge indirect on top.
I think if you're allocating them out, they're not really direct cost. The fact that they're taking rent, I think is one of the terms you used, and separating it out between the different programs, they are allocating those as an indirect cost, but they're just doing it in a little different method. But essentially, that's an indirect cost.
So can I clarify, if a subrecipient agency, and David, correct me if I'm wrong, submits a cost allocation plan where they specifically have broken out these line items for rent and financial support, accounting services, et cetera. The state would still be looking at making sure that those costs are not exceeding the LIHEAP administrative cost cap.
Right, but it's not really a direct cost. Those are, if they're allocating them, they're indirect costs.
Okay.
And they're allocating them because they're charged to multiple programs.
Sure.
And
so you're simply saying anything. Well, but I guess where I'm. So most of our subrecipients, most of them get the 10% de minimis. We don't have very many that have federally negotiated.
Really? Okay.
Direct cost rates. So if they are including their rent and utilities and all of that as their direct administrative cost, and then they are getting their indirect 10% indirect de minimis.
I wouldn't prove that personally. Now you could go and look to see what their costs are to say, does this, are they making a buck on the indirect cost rate? Because if what they're saying is we're going to just take the 10% de minimis, it's not worth it to, it's not worth the time to segregate these costs, and then they're segregating the costs and saying, oh, this is not really indirect, it's a direct rent. Is that what you're saying?
Yes.
Okay. I would think that I don't want to question their motives, but if I were in your position, I would probably question their motives, and then I would want to understand what are we actually paying in terms of indirect costs. And if you find that it's in total it's 12%, then you might be okay with that. If you're paying 40% because they're throwing so many costs and calling them direct, then you might want to reconsider your approval.
So really the only thing we should be considering as direct cost would be mostly salary, something tied very specifically to the, very specifically to the program.
Well, I would think payments to utilities for LIHEAP would be a direct.
Well, but that's direct client services, right?
Right. Yeah, that's how I would think of it. If you look, and if your state requires them to follow the cost principles, great. If your contractor grant agreement with them is silent on what they're supposed to do, you can either look to your own grant administration manual or whatever term you use, or if you look in, I want to say it's 2 CFR 200. I want to say 413. Lauren's going to quickly look it up right here. But I think it's 413 that spells out what the direct costs are. Oh, bingo, yes. 2 CFR 200.413 kind of gives you an idea of what should be in your direct costs. It's not prescribed. This is absolutely, these costs have to be direct and everything else is indirect, but it gives you some basic guidance. And then I believe it's 200.414 that has indirect costs, and it talks about what kind of costs in general are indirect, and they can give you an idea. And certainly rent is going to be one of those. If you if you pay rent for more than one program, in general it's going to be an indirect cost. But if they're getting 10% from you, and they're getting some of these indirect costs called direct, yeah, I would revisit that.
Okay. And my other question had to do with reasonableness. I mean, we've recently had a situation where a subrecipient was doing something that we did not view to be reasonable in terms of an expense that they were incurring, but the pushback that we even had some internally was, what is our right to, where do you draw the line between reasonable and unreasonable?
Yeah, you're not the only one that struggles with that. We struggle with it ourselves. When we talk about, and I'll use the example of executive director salaries at an agency. We were at one state that had an agency that had an executive director that made in excess of $350,000 a year. And for an agency that serves 4 people, that seems excessively high to me. But the agency was in a high-cost area and had $40 million in total federal award revenue. You know, if you want to get a good executive director in an area like that, that's in a high-cost area and that has experience with a lot of programs, maybe you have to pay that much. My first thought was it's totally unreasonable, but I don't have anything to back that up. I don't have anything to say. If I'm going to pursue that, I'm going to survey different nonprofits in that area of a similar size or a similar complexity, that have similar type of awards. Obviously, they're not going to all be CSBG or LIHEAP awards because this was a CSBG and LIHEAP provider. Now, the fact that this agency had some stumbles as well, it made me think that this person certainly wasn't worth $350,000 a year. But we were challenged with, well, what is reasonable? What should we do? And to me, if I deferred it back to, well, other federal awards limit to an SES level 2, and in that region it was somewhere around 181, 182 per year. That seems even that seems high, but at least that's a benchmark that I could rely on. It's not uncommon to debate what's reasonable and what's not. But if you are going to take a position that something isn't reasonable, it's probably prudent to do a little bit of homework and try to gather as much data as you can in that area, in that region. If it's something you can do. Because when I just showed up with my boss, I said, well, 350. He said, well, what's a reasonable amount? But I had nothing. So I had to go back and do some homework. And we don't know that we're actually going to do anything about this because we don't have a say in how states manage the CSBG award. But I was going to talk to our partners in LIHEAP, but ours are block grants. And so we're heavily reliant on the states to tell us what's reasonable. I think one of the reasons that we have block grants is that they don't want the federal agency to decide what's reasonable for everybody. So you're in a much better position than we are to tell us what's reasonable. I would recommend that you try to get as much support as possible. You have access to data on other agencies in your state. You can certainly reach out to other states to say, hey, our agency is spending X amount on a PR consultant. Is this even anywhere in the neighborhood of reasonable, or is this rate too high? That's certainly, and that's within your own region. It makes perfect sense.
And can I back up one more on my allocation question? We also have agencies that what they're allocating their direct payroll. So they have program specialists who they deal with clients coming in that would be eligible for CSBG, would be eligible for LIHEAP, would be eligible for weatherization. And so they're talking to them about all of those things.
Right.
What might we expect from them in terms of allocating those payroll costs?
I would think, if you're monitoring an agency that has, I don't know if everyone heard the question, but if you have some direct personnel that serve multiple programs and provide services for multiple programs to clients, and you're trying to divide up those direct costs, they should have some basis for why they did it, whether it's the total amount of activity in each program or a time study. I don't know if you've ever heard of those. They do have time studies listed in the Uniform Administrative Requirements that is as an allowable method to say, all right, intake in particular is one where we use time studies periodically, where we'll say, all right, intake for LIHEAP is typically 2 hours for one client. And if you look to see how many clients did you do intake on in a month, if it was 30, you got 60 hours, and you would make it a journal entry to take the 60 hours and allocate it directly to LIHEAP. I would expect some kind of report like a time study or some methodology similar to what they have for indirect cost allocations.
But probably not. They work on 3 programs, so we divided it by 3, right?
You know, I would if they're really unsophisticated, I would look at, well, what's the big dollar impact here? If we're talking about you know, $500,000 in grant revenue or grant expenditures, and you're talking about a cost difference of that might make a total of $1,000 over the course of the year, I would probably let materiality be considered there, because you know you don't. I mean, you don't want to come in and be the big bad state, and if it's really a really immaterial difference. I don't think DEA is going to stay up at night worrying that $50 was charged directly to LIHEAP and it should have only been $32. But if it's $50,000 instead of $32,000, that starts to become a bigger difference. Does that? I don't know if I meandered enough on that or equivocated enough to confuse you.
You did a great job.
Okay.
Okay, thank you so much, Tammy. That was a really helpful discussion. I know we're running close to the end of our session, but we have just a couple more questions to go through. Our next one comes from Ben Moore. Go ahead, Ben, your line is unmuted.
Okay, I just had a question about the basis for cost allocation plans and allocating costs. It looked like in that last example about the splitting the cost of that consultant 25%, the text of that looked like it was saying that they allocated it simply on the available funds. And I've always been told that's not an allowable approach. So say, you know, in most of our subgrantees, LIHEAP gets the most money. So they would allocate it if LIHEAP's grant funding is 75% of their funding, then they'd charge 75% of the cost of that item. And it seemed like that's what that was saying. And also back on one of the slides about allocating equipment, it looked like one of the options was available grant funding. And I thought that was not an allowable method. Am I making sense?
I'm listening to you. I'm trying to get to the slides to make sure I understand what we're talking about. I know it's way in the beginning.
But yeah, there was two. One of them was the one at the very beginning or close to the beginning. The other one was the very last one that talked about that consultant, the PR consultant. It looked like it was saying they allocated it based on available funding, but maybe I read it wrong.
Circle back.
Well, this is Tom. Let me just interject on the scenario. Yeah, that is more or less what the scenario was saying, but the point of it was, as we discussed it, I think that we all came to a consensus that that would not be a valid way to allocate it.
Okay, that's what I thought.
Trying to think on the other slide.
Wait. Okay, I'm still looking. You thought we said in the slide that that equipment could be allocated based on available grant funding?
That's what I thought. But
okay, let me make sure. If we said that, I want to make sure that we correct it before it goes out.
It was one of those flow charts that had the methodology on the right side.
Yeah, all right. He was. Wait. Right there. I think cost and, yep, sure enough. Page 20, we say equipment and supplies, percentage of activity, grant dollars, specific need. All right, so we have that in there.
Yeah, the grant dollars is the one that caught my attention.
Okay. And, you know, for the life of me, I can't remember when we discussed this, whether, yeah, we usually, when we go through these, we have a basis for, all right, how can they divide up equipment and supplies? Let me look into what we have in our notes. I don't have my notes with me, but we will make sure before Benita sends it that we adjust that. That's an excellent catch. All right, so we need to do an evaluation of LIHEAP in Illinois because he caught me. All right, I'm just kidding. No, that's a great catch. It may be that our brains were thinking this says one thing and it really comes out as something different.
Sure. No, I just have a lot of sub-grantees that would like
No,
to.
no, no. We don't want people to talk about, you know, using available grant dollars. There is, you know, I've seen one state that took, that had an approved cost allocation plan that approved it based on the dollar amount of their awards, but it was a state, and yeah, we didn't challenge it. I do think that I would have liked to have seen it differently in terms of how they allocated their costs. But they had like an accounting group, an IT group, an HR group, and some leadership and legal folks that were allocated essentially based on the total dollars that they spent. And their logic was, it was okay, but it felt too, no offense, Lauren, but it felt too lawyery. Like I think they came up with the method to be easy, and then they used justification for it. But that's not what we were thinking about when we talked about equipment and supplies. So I'll have to look at this.
Okay, great, thanks.
Okay, great catch, Ben. I have one last question for us, and I know we're a little bit over, but I think it's probably a good one, and that's from Doug Burns. So Doug, go ahead. I've unmuted your line if you'd like to ask your question.
Okay, thank you. If application and intake, the processing of verification documentation, eligibility documentation, benefit computation, and case files processing are not always included as administrative costs, then it would seem that they could be program service costs. However, there's no program service cost category in the state plan use of funds where you show that percentage. So how does the state show a fund budget allocation for these program service costs if they're not administrative costs?
I think where he's talking about is the one typically used with all that. Okay. You know, I only pretend to work in LIHEAP once in a while. So all of those costs that I think you talked about, application and intake, is that what you were talking about? Eligibility determination?
Yes.
Okay. Yeah, I would think if I were a state, I would say these are direct costs of our program. And mainly because in 2 CFR 200.413, it really says it in the very first paragraph where it says, you know, a direct cost is something that you have to do to comply with the program rules. And for LIHEAP, because it's a means tested program, you have to do some kind of intake. You can't just give LIHEAP money away. You have to do some kind of income verification, eligibility determination. You can't just do this you can't comply with LIHEAP without doing those things. So I would think of it as a direct cost, but I'm not sure I know what term did you use?
Well, see this program service costs. So you know, here it says on the slide that's showing, often included as an administrative cost are these. Well, if you counted it as something else, what would it be if it wasn't program service costs? Which, you know, a lot of states put those in indirect costs, and just because I don't know the reasons, but some states have done that. No, okay, so this isn't separating indirect from direct. This just talks about what are administrative costs and what aren't.
Right.
Yes.
So regarding administrative costs generally for LIHEAP, again, the LIHEAP statute and regulations, they do not define what are admin costs. We're looking to each state, tribe, territory to have their own written definition for what are admin costs. We will defer to your interpretation of what are reasonable admin costs, and only intervene if we think your interpretation is, quote, clearly erroneous, which is the regulatory standard for the block grant. And so we have seen a split among LIHEAP grantees. Some are a little more conservative or cautious and choose to include all of the salary and related benefits for those caseworkers as part of their admin costs. And that's fine if they choose to do that. And then we've seen other grantees that have separated out those salaries and charged them to non-admin costs because they are actually working directly with the households, probably involving some case management or, as David was hinting at, you know, the main thrust of LIHEAP is providing a bill payment assistance towards their heating or cooling. So that eligibility part has been viewed by some grantees as a direct service and not an admin cost. So we have been accepting either view on our recent monitoring visits. And if people have more specific questions about, you know, what you've been applying for your own programs, feel free to reach out to someone in our office here, and we'll be happy to talk about your more specific case.
Sounds good.
Okay, and thank you so much, Doug, for that question. So we want to thank everybody for joining us here today. Just as a reminder, we have recorded this webinar. We will have it posted in a couple of weeks on the OCS website, as I'm showing on the screen right now. So just as a reminder, where to get all of the very helpful LIHEAP training resources that are out there for you, including last month's Warning Signs webinar. It is posted and available for you. And then somebody had asked about where the information memoranda are on the website as well. They are also here on the LIHEAP page. So if you have any follow-up questions, feel free to shoot me a note. You can send it to Benita and I will get it to OCS, or feel free to follow up with your regional office liaison. I want to say a big thank you to Tom and John and Dave and Lauren for this great presentation today and for answering all of these questions. We really appreciate you all being here to give this presentation, and thank you to all of our wonderful LIHEAP grantee staff for getting on today and joining us. So with that, we'll end the webinar and let you go, but have a great rest of the day.